I think everyone's completed the technical dive. We're gonna switch back and talk about the financing. Interrupt me at will. My style is sort of to ask questions as I go, and we'll just dive right in. So in your course packets, on page 18 of the program guidelines, for future reference, you have a diagram similar to this, which gives you an overview of the actual application process for CPACE. Our technical administrator team, okay, which is the trifecta you heard from today, Anthony Bonacore and his team, Brian McCarter, Brian Bursteiner and their team, and then Celtic Energy, you will interface with these guys as just part of a slightly larger application process. So I wanted to make sure that you actually understand soup to nuts, how to submit applications for PACE financing, okay, what that looks like, how long it's going to take, and so on and so forth. So let me just walk you through this. This is basically the high-level process. The first step is to submit the CPACE application, okay? You have a paper copy of this application in your course packets. It's also an exhibit to the program guidelines. You can always email myself or Will McAlpin. We can send you a Word document of this, or you can go on our website, okay, to c-pace.com and click application. So there is a high-level application. It's about 4 pages, and this is the sort of hello, let's get to know each other application, okay? We're gonna ask for your name, your contact information. Are you the property owner, or do you represent them as their consultant, okay? And then we're gonna need the owner of the property to help you fill out some information on the building, okay? So that we can collect enough information to be able to go back and tell you whether this property is eligible for PACE financing. Okay, we certainly don't want to waste any of your or their time if they're not eligible. And I'm going to go through those requirements in just a minute. So you submit that high-level application to the CPACE team, okay, either through the internet or via email to myself or Will McAlpin. And we, at that point, will confirm that the property is eligible. Okay, you will receive an email back saying, yep, this is good to go. At that point, if the property is eligible, we then will license the project for you in the CEFIA data management platform. Okay, so at that point, you'll get an email from Brian Bursteiner, Brian McCarter. You'll be issued a login and a password if you don't already have one. Okay, and then the actual project will be licensed to you. So you'll be able to get into that platform and start building the project. I think you've seen a lot about the CDMP at this point, so you understand that it has a lot of different tools you can avail yourself of, and we essentially at this point, it's in your court, okay? But at some point in time, you're going to inform Brian and his team that you've got the winning scenario, okay? You've decided that scenario number 20 is the one that the customer, your client, wants to move forward with on financing. Okay, so at that point, you would let us know. And before we can review your application, all of the data has to be complete in the CDMP. Okay, you've got to have all the project data in there, and the financial application has to be complete. Okay, so there are a couple documents we need from the owner on their financials. At that point, the project undergoes a review. Okay, there's a technical review process, which you heard a lot about today. There's also a financial underwriting process that happens simultaneously. Okay, within CEFIA, we underwrite these loans. When we approve these projects, the last step, typically, sometimes this happens earlier, is that we'll work with the property owner to help them get consent, okay, from their mortgage lender if there is one, and there may have been some questions on that, so we can talk about that now. And then we can cut a check, okay, then it's financing. So this is basically the high-level overview of soup to nuts, what these applications look like. And in your in the program guidelines, which is why I wanted you to see that diagram, read those 2 pages, just 1 second, we've estimated for you how much time each of these steps take, okay? Because we get that question a lot, you know, can I get financing in 3 weeks? Can I get it in 3 months? And the answer really is, it depends a lot on you all. You know, we can turn around material relatively quickly. We find that the longest part of the sales cycle happens in the scoping of the project, okay, and getting all of that project data and pricing out every energy conservation measure. Oftentimes there can be a bit of a bottleneck with getting LOA from the utilities if you're applying for incentives, but we can turn around material relatively quickly. So We estimate that for a fast track project, okay, minimum you're looking at 4 to 6 weeks from when we start reviewing it, okay? I can't control how long it takes you to pull together the project, but once you submit it, you should be able to close on financing within 4 weeks. If it's a full assessment project, it's going to be a little bit longer, okay, 6 to 8 weeks, because the review could take longer. Okay, that's not set in stone, but that's our best guess. We can go a lot faster if we need to, so just know that we're very willing partners, and if you give us a big enough heads up about what your deadlines are, we will do our utmost to meet them. There was a question here.
At which step do you think for the LOA would really be required?
Okay, great question. The question was, at what step is the LOA from the utilities required? You'll see in here that in step number 1, oh, it's not in there, it should be. It is in here. It says that step number 1, you submit the initial application to CPACE, and you also should at that point have gotten your project on the radar of the utility company, okay, whatever service territory that's in. The reason for this is they have their own process, okay? For any of you that have used those programs, and now that you've heard about our program, you know that they're measuring something completely different, okay? We're interested in the cost savings to the building owner. The utilities in our state are interested in how much energy buildings can save over what is currently our standard state building code. It's pretty different. So we really encourage people to do this right away, okay? Get it on their radar, because they get backlogged pretty quickly, and we do not want that to be the bottleneck standing in the way of your customer getting their PACE financing. We don't require utility incentives, but if you've got $1 million project and the owner expects to get $200,000 in incentives, and they would like to then finance $800,000, then we definitely can't close on financing till that $200,000 is in a LOA that's executed. So we can move into the review phase here without an LOA, okay? We can use as sort of a placeholder, but we definitely cannot close on financing until that's in place, okay, if it impacts the finance amount. Does that make sense? So get it on their radars early. I think I heard Anthony say if we see project data come in and there are no estimated utility incentives, someone's going to ask about that. And we've seen projects get delayed because the contractor didn't sort of press that early enough. We work very closely with the utilities. That's why we have a fast track for projects that you've already completed through their review. So we certainly can assist in trying to sort of line up those timelines so that they don't extend beyond one another. Okay, great. So I wanted to cover some of the non-technical pieces of CPACE. There are other requirements that these projects have to meet.
I actually have one question about what you were just talking about with the power companies and you guys.
Sure.
There's this whole, it has to be an incentive from the power company, Do you guys ever run up into problems where they say, well, you're obviously doing this project, we're not going to incentivize them, you're going to do.
Yes.
You have CPACE financing, so why do you really need our money?
Okay, did you all hear the question? Yeah. Okay. Have you all had that experience? Anyone else? All right. So the Connecticut Light and Power, United Illuminating, the regulated utilities in our state, there are limitations on free money that they can give away through these incentive programs. And if you're working with a customer that has a lot of deferred maintenance, that there are pieces of equipment that are essentially past their effective useful life, the utilities are not going to provide incentives for replacing that equipment, okay, because the owner should have done it already. They're essentially not compliant with existing building codes. And those are all eligible for PACE financing. So you would never be in a situation where the utilities can deny funding as long as the measure is eligible. And oftentimes, even if it's a piece of deferred maintenance, okay, if you're putting in a super efficient piece of equipment that goes above and beyond the call of duty, if you package that into a comprehensive project, you may end up getting kind of marginally some dollars for that. But anything that is eligible for the utilities, we can finance, certainly. And anything that they will not finance, again, as long as there are cost savings to the owner, that can be financed through CPACE. So gas conversions are a perfect example of this. Okay, if you're helping someone convert from fuel oil to natural gas, there are not incentive dollars for that type of improvement, but there are clearly enormous cost savings to the owner, and those savings can be used in kind of your energy savings budget, if you will, to develop a PACE project. Does that answer your question? Okay. All right, great. So let's just switch over, and quickly I'd like to go through the other requirements for PACE projects. You are not expected to remember all of these. Okay, that's what the CPACE team is here to help you do, is to remember what these eligibility criteria are. If you're working with a new customer or you're scoping out a project and you're not sure it's eligible, email me, call us. We are more than happy to kind of get involved early and help you guys think through these issues, but I want you to at least be aware of them. All right, so these are also in the program guidelines. There are some basic eligibility requirements buildings have to meet. They have to be in a CPACE municipality. Okay. If you are working with a customer that is not in a CPACE municipality, again, please email myself or Will McAlpin. I was just in Cromwell, okay, meeting with their tax collector when I was away at lunch, and they're going to join the program in April. Okay, and that's because Noresco told me they had a project there. So we do that all the time. We make those house calls. The applicant has to be the legal owner of the property. Okay, this is something that happens frequently. We'll get in an application and we'll get to the end of that, 7 steps, and we'll realize we're dealing with the tenant. Okay, the tax bill goes to the property owner. So ultimately they're the ones paying it. You heard that these assessments can be passed through to tenants. Okay, so this isn't a problem, but the owner has to be involved. Okay, they're going to be signing on the dotted line. So it's really, really important that the owner is in the picture probably sooner than later to avoid any closing risk for you all. And again, we have a lot of experience speaking with property owners. And if you are working with a tenant, okay, particularly a large tenant or a manufacturer, that's really the only tenant of a building, they have a lot of control over what happens in that building. They pay the utility bills, and more often than not, they probably pay their portion of the tax bill. So don't write them off, okay? If they go to their owner and say, you have to do this to keep me happy, otherwise I'm not extending my lease, and Anthony will tell you this happens frequently, they'll be interested in doing it. And I think you've all heard today that there are huge benefits for property owners using PACE financing, okay? They get a state-of-the-art building that they're gonna hold on to. This would make it easier for them to release their building and so on and so forth. So again, we can help you if you're with a tenant and you can't kind of figure out how do I get the owner in the picture, but the owner has to be in the picture. So make sure you ask that if you're not sure. Okay, the property, I think you already understand what are eligible facilities. We went over this. No residential homes, no municipal buildings. The property must be current on property taxes and assessment payments. Okay, again, we're not expecting you to check this. This is part of that initial application. When we get that, the first thing we do is we call the tax collector in that town. If these guys haven't been paying their taxes for 5 years, project can't happen. Okay, so they have to be current. And the last thing is the property can't be in foreclosure. Okay, there can't be any involuntary liens or judgments on the building. An exception to this, which we are working on several, is if the building was previously in foreclosure and it's been purchased. Okay, you've got someone coming in that's planning on renovating the facility, clearing the blight liens, essentially, making a productive building out of one that was formerly vacant. We really encourage this. So if it was recently foreclosed upon, but it's moving in a better direction, that's okay. Okay, but there can't be a foreclosure in process. Any questions here? Yes.
Could it be a brownfield?
Okay, the question was, can it be a brownfield? And the answer is yes, within the confines of this. So again, actually this facility in Cromwell that I'm speaking about, it wasn't a brownfield site. Okay, the manufacturer that's moving in there purchased the facility for $1 from the state. Okay, they did the environmental remediation, and now they're fitting out the property and financing that through CPACE. So we don't do any environmental impact studies. We don't require that. But again, if a building is in a brownfield, it's possible that it's in foreclosure or there are involuntary liens or judgments on it. They might not be current. So it would have to sort of fit the rest of the bill here. But again, if you're unsure, call us. We're interested in learning about this property. Any other questions? Yes.
Earlier you mentioned that your example about the process, and at the end, you cut a check. Who does that check go to? Does that go to the owner, or does it go to the vendors who did their work?
Okay, the question is, who do we write a check to? The answer is it can be the owner or the vendor, but hold that thought, and I'm going to get to that in just a minute. Okay. Any other questions here? Keep blazing through. Right. Okay. Other key eligibility criteria, you've heard probably more than you ever wanted to know about the savings to investment ratio. That's the big one. There has to be an energy audit or feasibility study. The term of the PACE assessment cannot exceed the useful life of the measures. We covered that today too. And they have to be permanently affixed to the property. Now, did Anthony touch on this piece? He did. Yes. Did he talk anything, did he speak at all about microgrids? No. Or just, okay. There is an exception to this, which is for those of you, and I know there are some in the room that are actively working on microgrids that also might be funded through the Department of Energy and Environmental Protection. Right now, if you are a developer of combined heat and power projects or geothermal projects, you can site that plant or that well anywhere, and the cost of that generator, okay, plus the distribution network essentially for the thermal energy, that can all be financed through CPACE, okay, and the cost of that can be apportioned to the benefiting properties on a pro rata basis. Part of what allows this, and I hope this was covered during the solar component, because I know we've got some solar folks in the room, the owner of the property does not need to be the owner of the equipment under PACE. And that really only becomes relevant with renewable energy technologies, but essentially this means that there can be a third party that owns the solar panel, or that owns the geothermal well, or that it owns the microgrid infrastructure, okay? That's essentially selling energy and energy services, okay, to beneficiaries. Right now, this is only for thermal energy, but hopefully within 6 months, this will extend to power as well. Okay, so that's the one exception to the permanently affixed. Okay, so we're gonna get a little into the financing here.
Can I ask you a question going back? So it only covers the thermal energy on a microgrid, not the electrical?
So the question was, is it just the thermal, not the electrical? And the answer is yes.
Right now.
Yeah, it's a bit more complex, but essentially it covers the power as well, but it's not actually possible to sell power outside of the utilities. So, okay, but essentially, you know, let's say you have an industrial park, okay, and the buildings in that industrial park are interested in cogeneration, and it makes sense to size a larger plant, okay, that's going to service all of the buildings in that industrial park. Locally, okay. The cost of the cogeneration plant, the combined heat and power plant, as well as all the piping, the trenching, everything to get that steam or hot water to them, okay, all of that, as well as the CHP, can be financed under PACE and apportioned pro rata on a savings basis. Okay, the reason it doesn't really extend to power is that power is going to be injected into the grid, okay, because it won't be behind a customer meter. Okay, great. All right, so everything I just covered are actual statutory requirements. Okay, those were all eligibility requirements where our hands are tied. Okay, we can't color outside the lines for anything I just described. What I'm right about to describe now are our underwriting standards. Okay, how we approve loans. What are some of the restrictions? And I want you all to be aware that this is specific to CEFIA's capital. Okay, and I'm going to speak in a little bit about how we actually get money into these projects. But for the most part, most of these projects are financed directly by CEFIA itself. Okay, so we're the first lender in. We might get bought out by someone else, but all of these projects you see around the room, that first check, okay, the construction loan, it came from CEFIA. So these are our underwriting criteria. If you are working with a customer that has a bank that's ready to put up the money directly, okay, this would not apply. They have their own underwriting standards. All right. So let me just go through a couple of these briefly. We look for the following things. The first is we look for what's called a loan to value ratio. That says LTV on our property. of no more than 80%. How many of you have a mortgage on your home? Okay, so you would all be familiar with this, okay? The value of the property is $1 amount, and the loan is all of the debt that's secured by the property. CPACE, as you know, is also secured by the property. The property is the collateral for the loan. So we look at if they have a mortgage, how much their mortgage is worth, and whether they're exceeding this threshold, okay, which is pretty standard in commercial banking. If they are, we'll still look at it, okay, but they more or less should not be. And the reason is that if they are, they're very unlikely to get consent from their mortgage lender. Okay, their mortgage lender isn't going to let them go above this number, and for the most part, neither are we. Again, you don't need to find this out for yourself. Okay, we will do the math here, but this is something to keep in mind. And the read between the lines here is that if the building is underwater, okay, we're not going to extend them PACE financing. So if their mortgage is worth more than their building, we can't extend financing to them. The next thing you see here is lien to value. Okay, what is the ratio of the cost of the PACE project just by itself to the building's value? Okay, and we look to limit our exposure to 35% of the building's value. Okay, again, we do go over this. We have some of these projects, they had no debt on the property. It was worth a lot of money, and they wanted to wholly transform it, and they had some other great things going for them that allowed us to get comfortable around that. But this is also a basic thing to keep in mind. So if you're working with, a small commercial facility that's worth $1 million, unlikely that you're going to have $1 million PACE project on that property. Okay, it's going to need to be smaller. Do both of those make sense so far?
Yep.
Great, excellent.
The loan to value, though, is that with the upgrades?
Ah, great question. Did you hear that? Does the value include the upgrades? Well, it should, don't you think? Okay, so the answer is it depends. CEFIA looks at the value of the improvements, okay? However, and it's important for you to know, an existing mortgage lender might not. Okay, so if they have a mortgage on the property, and there are lots of cases of this, where they wanted to go slightly above 80%, we will do the math for the lender and say, hey, if you take into account the improvements, we think they're well within the 80%. And a lot of lenders are completely okay with that. Okay, others aren't. So it depends. But CEFIA, in terms of our underwriting and the extent to which we will lend money, yes, we look at those improvements.
Looking at getting a new commercial appraisal on every project.
Okay, the question is, do we need an appraisal on every project? The answer is no, but if they have had a recent appraisal, that's the best case scenario. If they don't have a recent appraisal, we look at the most recent appraised value through the municipality. Okay, and depending on the projects you're working on, it's often beneficial for the property to get a new appraisal. Okay, again, for purposes of getting consent from their lender or to enlarge the amount of financing we will extend to them. So to give you an example, we've approved financing for a large solar facility, okay, that's being built at a manufacturing complex, a very large manufacturing complex that hadn't been appraised in 30 years. So the last standing appraisal was pretty low. So they said, hey, it's definitely worth $1,000 for me to go and get this thing appraised. They did. The figure came in something like 400 times the size of their previous appraisal, and they were able to access $1.5 million to build that solar project. So again, it is case by case, but this is what the CPACE team is here to help you guys do. In addition to Will and myself, we have a whole finance team that just looks at stuff like this. So again, if you have questions, just let us know. We want to see what's possible. Okay, that's a great question.
The appraisers, you guys, can anybody do the appraisal? Or does it have to be approved?
Okay, the question was, can anyone do the appraisal? We are not appraisers. There's actually a whole process, and there are regulations around appraisals, who can order them, who can pay for them. So no, we are not doing that, but we read them, okay, and we understand how they are completed. So we can give folks a kind of best guess of what an appraiser would look at and how they would evaluate the project.
I just didn't know if you had the list that said these would be.
No, we don't make those types of referrals. Typically the bank needs to order the appraisal. Okay, a property owner isn't allowed to order and complete their own. It has to be their lender. Yes.
Are you seeing anybody, are any of the lenders requiring environmental due diligence like phase 1?
Okay, the question was, are the lenders requiring due diligence on the environmental side? I have not seen that yet. We have, okay, most of these projects you see around you, they all have mortgages on them. So there are many, many banks in the state that are consenting to these assessments, which is great. Okay, it means that they get it. They get everything that we've been talking about all day in terms of the benefits of these projects, in terms of the cash flow of the property, the liquidity of the owner. So banks are consenting all the time. Sometimes they have conditions. Okay, that has not been one of them yet, but there have been others. Other questions? Okay, keep thinking of them and ask me. All right, so those are the two big ones. There are a couple more. Again, you're not going to need to worry about this, okay, but this is part of that financial application. So we do need this information from the owner. You know, we look at their balance sheet, we look at their income statement to make sure that these are met, and if they're not, you know, we want to know why. But essentially, we want to look at the past 2 years of their operations and their balance sheet. Are they positive? Okay, have they been operating in the black or operating in the red? We're going to look at the debt service coverage ratio on the building. Okay, this is really important. You heard Anthony talk about limited liability corporations. Oftentimes, these buildings are owned by a different company. Okay, even if you have a company that owns the business in the building, they've probably established a separate holding company for the property itself. That's what we're most interested in. Okay, we're not running credit scores on these businesses. We want to know what the cash flow of the property itself is. And that's good for all of us because it's much more straightforward. Okay, there aren't that many cash inflows and outflows. It's, you know, how much rent is the building taking in and what are its expenses, okay? And utilities are a big part of a building's expenses. So that's what we're looking to bring down. When you do these projects, okay, that should make their debt service coverage go up, which is a good thing. Okay, so we look for that. And we look at their total liabilities, their total net worth. Again, have they taken on a huge amount of financing elsewhere in their company that would essentially put them at risk of not being able to repay their PACE loan? Any questions here? Okay, great. All right, so what can you do to sort of let this inform you? We try to do as much of our financial due diligence as possible up front so that there are no red flags for you, so that you can move forward with confidence that if you want to finance a project with PACE at the end of the road, you know, the pot of gold is waiting for you at the end of the rainbow. Okay, that's our goal. We definitely want everyone to move forward with that confidence. That's why we require now that these initial applications be fully filled out so we can make sure the property is eligible. And that we can give you some eyes into these figures. You know, how much is that building worth? You know, you might have been planning to go do a $2 million project, and we can tell you pretty early on, hey, that's too aggressive, it's too ambitious. You know, they're not going to be able to get there at the end of the day. So these are things you can keep in mind. Okay, again, we do this, but you could do it on your own if you have the information. Estimate the loan to value and the lien to value. Okay, what is the building worth? Again, you could just submit the application to us, but if the owner doesn't even want to fill that out, look at the property. Does it look crummy or does it look like it's doing pretty well? You can access these records online. Okay, all tax assessors list the value of the property, okay, based on the town's appraisal. So if you're just kind of scoping out a customer, you're not ready to submit the application, you can still do some due diligence here. Estimated debt service coverage. Again, this is all about that savings to investment ratio. If you have a project that can cash flow positive over 20 years, you're going to improve their debt service coverage ratio. Okay, and SIR has to be greater than 1. An SIR that is greater than 1 is better than an SIR that equals 1. Okay, really important to keep in mind. You've heard a lot about the SIR today, but it's pretty intuitive. If you have a 20-year project and the SIR equals 1, that means that your customer is losing money half of the time. Okay, so some property owners are okay with that, but others might not be. So when you're putting these projects together, really, you know, use the CEFIA data management platform, use us, use Brian. We can help you guys look at a project and point this stuff out, like, hey, this looks a little strange. Have you thought about this? Okay, so that's something important to keep in mind. And of course, other obvious red flags. history of bankruptcy, the property's in foreclosure, the property is held, this is sorry, I apologize for all these acronyms, a commercial mortgage-backed security. Okay, if you're working with any snazzy Class A office buildings, it is possible that that loan has been securitized, okay, meaning they don't just have to answer to one bank, they have to answer to hundreds of shareholders, okay? Luckily, there are not many of these buildings in our state, but there are some. That's gonna be a difficult project to do with PACE. And if you're unsure, contact CEFIA. I've always been told not to say I'm from the government and I'm here to help. But in this case, it's true. I work for a state agency and I am here to help. So, you know, we really enjoy the relationships we have with registered contractors. They call us often with projects that are in very early stages just to kind of get our take. So I really cannot encourage you enough to just get us involved. We make house calls all the time. We'll drive out to manufacturers anywhere in the state. And you know, we'll meet with the owner. If you don't feel comfortable describing the financing, see if one of us can come with you on that site visit to speak with the customer. Yes?
Genevieve, are there any thresholds, like other state programs that require, for example, a business to be existing in the state of Connecticut for a minimum of 1 year before they can take advantage of programs like this with the PACE program?
So the question was, are there any limitations on the period of time that the business has been in Connecticut? The answer is no, not for CPACE. So, pardon me, if you're working with, you know, a manufacturer that's looking to move from Tennessee to Connecticut and they want to use this money to rehab out a facility, great, they can do that. Okay, terms, rates, and fees. I like doing this at the very end because usually this is the first question people ask me and I say, no, but there's so much more to CPACE than the interest rates, but you're always going to get this question. Well, what's the interest rate? Okay, well, I'll tell you. It starts with the term. You all know that the effective useful life sets the maximum term. If you're doing a lighting project, you will not have a 20-year term. You'll have a 13-year term. Okay, so the term is sort of what anchors the interest rate. We have published our interest rates, okay, and they're, again, in the program guidelines, but we have a sliding interest rate scale that is linked to the term, okay, unless we negotiate something special. So essentially, it's 6% for 20 years, okay, and then it goes down 1% for every year. Okay, so it would be 5% for 10 years and 5.5% for 15 years. It can be the EULs, or savings or cost weighted, as you know. You've got the terms and rates up there, and this is subject to our discretion. Okay, again, these are rates that we've published, but we are the green bank, so there are a lot of creative ways to adjust these rates. I'll give you an example I'm really excited about. We've been doing a lot of work with YMCAs in the state, and we're working with one that wanted to put in cogeneration, okay, to heat their pool and their showers. We went out and said, you know, there are other funds out there for combined heat and power, and we encouraged them to submit another application to access what otherwise would be kind of a grant fund, and we used it to buy down the interest rate on their PACE loan. Okay, so they're gonna get this comprehensive energy efficiency project, and they're coming in under 5%. Okay, they're at about 4.7%. So again, let us know about the project. If you're working with an owner that's really interest rate sensitive, you know, we'll look at that. But I hope you all have the message at this point that CPACE is about cash flow. Okay, it's about how much can you return every year. Okay, how much extra money can you help them put in their pocket every single year as soon as your project is implemented. Okay, it's less about what's the payback. Is it 3 years? Is it 5 years? Okay, the answer is with CPACE, the payback should be 0 years. It should be immediate. Okay, and that's really the benefit of this type of financing over another type, which might be better for them, but this is the important piece of this. Okay, and then fees. CEFIA does charge closing fees, and that schedule is also in the program guidelines. The highest fee is 3%, and that's for our smallest projects. Okay, and then the fees go down as the project increases in dollar volume. Those fees can be paid at closing, or they can be wrapped into the financing and amortized over the full 20 years. Okay, so it ends up being pretty negligible, but these are there so you can be aware of them up front. Okay, any questions about interest rate? Yeah, I thought I'd have a few. Let's start here.
I have a question about debt service. So for the person paying the note down, they're gonna pay it twice a year. Are any funds escrowed or?
Okay, great question. The question was, do funds have to be escrowed? No, they don't, unless that is a condition, for example, of a bank. You know, their mortgage lenders might say, I'm okay with this assessment, but you have to escrow funds in the same way you would for your taxes. Okay, but it's not a requirement. I saw other hands. Yes?
Does 3% for the CEFIA cover the SRS fee and all the other fees in there? That's all combined in that 3%?
Yeah, the 3% covers all of our program-related costs.
How about the monitoring and verification portion of it?
Okay, the monitoring and verification should be a separate line item in your project. It can also be wrapped in to the financing, but that's a project-related cost, so that's separate.
So is that in the financing of it, or is it outside the financing?
It can be included in the financing, but it's not included in this fee. Okay. Yes?
Is there a legal cost? Do you need an attorney to close this?
You do not need an attorney to close this. However, it is there are closing documents, so oftentimes they're going to want their lawyer to look at it. Okay, but we don't require that, and we don't have legal fees.
What's the quality of the financial statements you require? Are they review or just independent?
Question was, what's the quality of the financial statements we're looking for? You'll see on the initial application, we ask for previous 2 years balance sheet audited, if possible. Okay, so if you're working with someone that has their financials audited every year, that is preferable. However, it's not a requirement. So we work with a lot of property owners that keep, they have accountants, they keep their own records, and we'll work with what we have. But if someone sends me an application where they write it, handwritten, that's going to be an issue, and we're going to ask them about that.
Tax returns work?
Yeah, tax returns do work. Yeah. Yes.
Is this stuff subject to freedom of information that's submitted to you?
Great question. The question was, is this subject to freedom of information? In the initial application, there is a page about freedom of information. So if you get this question from anyone you work with, refer them to that. That page has been pored over by our lawyers, so that's the actual suggestions. But CEFIA is a state agency, okay, so we are subject to the Freedom of Information Act. However, there are many, many exemptions to what anyone can access through a FOIA request. And any information that is proprietary, that would harm a business's ability to operate, trade secrets, certainly their financial information is exempt. So no one can access this through a FOIA request. However, we provide instructions for what an owner should do if they are nervous or overly cautious. They should actually mark up the documents and circle and actually dictate what is exempt and under which piece of the statute is exempt. Okay, so that is the best way to go about it. But in general, a property owner's financial statements are not subject to FOIA. But great question. I'm glad you asked that. I saw. Yeah.
I just had a question about ESCO fees for managing a project. Can they also be wrapped into the financing under the program?
Yes, ESCO fees, your overhead, et cetera, we expect that you're wrapping that in, either as a separate line item or priced in. Okay. Yes?
How and when are the loan funds dispersed to the borrower?
Okay, great. Okay, now I have to answer that because you're the second person who asked. How and when are the loan funds dispersed? The loan funds are dispersed according to the construction schedule that you establish with the owner. Okay, so when we have closed on financing, at that point in time, the funds are allocated. Okay, they're available, and the closing documents are going to include your service agreement. Okay, with the owner. We're not a party on that document, but it's included. So we are going to assume that you're going to draw down on funds according to that schedule. Typically, owners don't want to make all that money available to a contractor all at once, so it's for their benefit as well. And we will look at that schedule and we will reference it when we receive a request for funds. Okay, so the owner has to submit that request, and it will say, I'm at milestone 1, which I was supposed to meet by this date. we've ordered all the materials, I need an advancement of $200,000, okay? So it goes a bit like that, and they can say, please send it to me, or they can say, please send it to my contractor, okay? And we can do that by check or wire transfer.
So can I ask a further question? As an example, if we sign a contract and we have our terms that say it's basically a payment schedule, then that contract would be a part of the final closing, and that's
Correct.
what you determine.
Correct. So he was saying, you know, if we put together a payment schedule, would that become part of the closing? And the answer is yes. So we have a cover sheet at this point that the owner has to submit. Okay, that goes to accounting, but we're going to be looking for all of the conditions, okay, to dispersing money to be in place. And there are a couple that I find surprise contractors because they don't read our documents carefully. The first payment, you have to have your permits in place. Okay, so I know that this impacts solar in particular. You need to have that permit in place before we'll extend the first tranche of funds. Okay, again, with very few exceptions, but that's to prevent everyone from getting into a messy situation. Okay, we don't want any money out the door if the town, for some reason, were able to not allow the project to move forward. Another is that, you know, the property has to be insured and has to continue to be insured throughout the construction. CEFIA also will keep a very small retainage at the back end to make sure that the project is commissioned appropriately. But yes, other than that, you are in the driver's seat. You establish that schedule. You're welcome. Okay, any other questions here? All right, we'll keep going. Oh, that was the end of the financing. All right, last chance. Questions about the financing? Yes.
You keep mentioning about the lenders and then CEFIA with the disbursements. Now, the initial upfront cost, does CEFIA pay and then the lender takes over at the end, or the lender's really paying? The
question is essentially, what is CEFIA's relationship with our investors, our lenders? And I'm going to tell you what the relationship has been to date, okay? But this is very fluid, which is that CEFIA, as I said, we are financing these transactions off the bat. And the reason, more or less, is that we are able to offer better interest rates, okay, than what that individual could otherwise probably get without CEFIA in the picture in some way. So the way that we have been doing this to kind of get this program up and running is by financing these transactions as soon as they are shovel ready, okay? And then we are packaging together larger volumes of projects and bidding them out to a list of registered lenders, okay? So they're essentially purchasing larger volumes of loans. And that is what happens on the back end, but it doesn't impact the borrower. Okay, so once we finance a transaction, all the paperwork is filed with the town, and they will expect and should expect to keep that term, interest rate, the payment that was in the finance agreement. They're stuck with that. So if CEFIA can't successfully sell that transaction, that becomes our credit enhancement. That's where we might take a small haircut.
That's what's just coming up, right?
That's right.
And how often will you change the rates, or potentially how do you determine them rates? Just for the future, so we have an idea.
Yeah, we would not change our interest rates without providing a little bit of headway for everyone. So as an example, we started charging fees in November of last year, and we made an announcement about that in the summer to let everyone know that if you have an application, if you get it in by October 31st, you will be grandfathered in. You will not see these closing fees for all projects moving forward. You will. So if there are any measurable changes to anything I've just said, everyone on our registered contractor list would have a good amount of headway to prepare for that.